Okay, we can get started. Hello, everyone. Thank you for joining us for today's webinar. This is the first installment of the AgAnnex Focus on Farm Finance webinar series. My name is Quentin Moorhead. I'm the National Account Manager for Top Crop Manager and Potatoes in Canada magazines. I'm joined today by Steve Funk, Director of Ag Risk Management Resources for M&P. During today's session, Steve will discuss a review and analysis of business risk management. Thanks to M&P for sponsoring our session today. M&P is the leading national accounting, tax, and business consulting firm for Canada's agriculture industry. We have invested more time and resources into understanding agriculture than any other firm. With more than 18,000 agriculture clients and a team of more than 600 agriculture specialists, M&P delivers a diverse suite of services to protect farmers and maximize results. This webinar is being recorded and will be made available to attendees and registrants approximately 24 hours after our live broadcast. This session is scheduled to run for approximately 45 minutes. Steve will speak for about 45 minutes, and following his presentation, we'll open the floor for questions. If you have any questions throughout the presentation, please feel free to type them in the question tab found on the GoToWebinar panel of your computer screen. This webinar has been approved for 1 CCA CEU in professional development. Further instructions for submission via QR code or by email will be addressed after the question and answer period. Without further ado, I'll let Steve take it away.
Thank you, Quentin, and thanks for the opportunity to deliver this webinar. The webinar is entitled Business Risk Management, What's on the Horizon, What's Right in Front of Us, and What's the Common Denominator. I just want to point out something here on this first slide. At MNP, we have a division that's called ARMOR, Ag Risk Management Resources. This is something that's fairly new for us. We've always had farm income programs or Agristability Agri-Invest division, but a couple of years ago, we rebranded this into Ag Risk Management Resources. So you're going to see that we've taken a broader business risk management focus, and that will show throughout the presentation. So again, what's on the horizon, what's right in front of us, and what's the common denominator. So we'll start with what's on the horizon. As I was preparing for this webinar, I looked at the website of Top Crop and noted in the About Us section that Top Crop likes to not only look at current issues today, but look out about 3 years. And I thought, well, that's perfect, because that's actually what business risk management is doing right now. We're kind of looking on the horizon. We're looking at both what's going to happen with the rest of this Canadian Ag Partnership Framework in 2020, 2021, and 2022. And we're also looking forward to what's the new Canadian Ag Partnership, Canadian Ag Partnership 2, if you will. What is that going to look like? So that's in 2023. So as you know, there's currently a deal on the table. The federal ag minister has given the provinces 2 things to consider. And you know, it's actually very timely that today is the federal provincial territorial meeting where they are regathering to talk about this again. And so here I've termed this in terms of you know, a checklist, if you will. So I think when we see the outcome of this meeting today, some of these boxes are going to be ticked, and some of them are going to have X's. And so, of course, the 2 main things that are on the table are the first 2, the removal of the reference margin limit from Agristability, and the change in the contribution rate from 70 to 80%. Now, the reason I put those as 2 separate boxes is that I don't think it's out of the question that one of those might be accepted and the other might not. No, that's open for discussion. So hopefully you see at least the removal of the reference margin limit. That's a very important program feature that has to go, and we'll show you why in an upcoming segment here. I also have two other boxes because at first this was all billed as, okay, we're looking at this for 2020 and future years. It wasn't spoken of in the press conference that happened last week, but I've heard it spoken of afterwards that now it might not necessarily be effective for 2020. So it might be effective for 2021 and future years. So again, a couple of alternatives there. But the big question is, are all the prairie provinces going to sign on to these changes? And then looking a little further onto the horizon, we've got the Canadian Ag Partnership 2, if you will, a new 5-year framework that's going to be from 2023 to 2027. And currently there's a number of research projects and consultations that are ongoing, and they're considering the following things. And, you know, again, I have them listed because with the open boxes there, because I think some of these things may end up happening, some of them may not. So the things that are being considered are further changes to agristability, margin-based insurance to replace agristability. You know, those two, of course, are alternatives. A separate disaster program that would be in addition to either the margin-based insurance or the agristability. Livestock price insurance potentially moving east. Currently, it's available in the western provinces. There's some studies that are being conducted in the east, and hopefully we see that move east. And continuing, I have this last one here that's bolded, continuing encouragement of private insurance solutions. So this has been a theme for a number of years now with these frameworks, is that they're encouraging private insurance to come into this space. I'm going to focus a little bit more on that on the next slide. But of course, the big question with all these things that are on the horizon for the next framework is, will the CAP 2 framework be BRM Utopia? And so here, as we consider that next framework, two major ingredients of BRM Utopia would be more money and a return to simplicity, or, you know, basically simplicity if you think that you never had it before. So more money for everyone. And here I want to caution producers that, remember, as the consultations went on relating to agristability that built to the deal that's currently on the table, the biggest ticket ask for this current CAP framework was the ask for the trigger point for agristability to be 15% instead of 30%. That, of course, did not make it onto the table as part of Minister Bibeau's offer. So we have to remember that. It didn't make it onto the table now. And in fact, the lesser items that actually are on the table, there's still a healthy degree of debate over those. And so I think it's safe to assume that the next framework is not going to necessarily have more money. And if producers want it to, I think that a different approach, a different tactic might be necessary. So just keep that in mind as you work with your various producer groups and try to influence this for the next framework. The second thing here that I call one of the main ingredients of a BRM Utopia is a return to simplicity. And here I use some hyperbole or some exaggeration to prove a point. I say a return to simplicity with self-revealing programs that can be learned and understood via 10-minute drip IV sessions. So of course I'm exaggerating here, but you know, sometimes this is the way that it seems, is that it seems that people want these programs to just be self-evident, that a program will be launched, a new program might replace agristability, and after sitting through maybe a half hour or hour session, Everybody will understand it. It'll just be completely evident. They will understand it for the rest of time, for the rest of the framework, or however long they need to. And my caution is that it's going to require more effort than that. And this is where we get to the right-hand side of this slide. The reality is that significant changes to or replacement of agristability or not, I think the BRM space has been getting increasingly complicated, and it's going to continue to get more complicated as more programs are added. So you'll recall that on the last slide, I talked about this theme of encouraging adding more programs. So as more programs get added to the space, it becomes more and more complicated to make the decisions. And so, you know, again, looking long-term on the horizon, I think one of the main things that producers need to be looking to is there has to be some ways and means of tying the programs all together so they can be properly evaluated. And that is what's going to emerge on the horizon, is you're going to start to see people developing ways and means of tying this all together. Okay, so moving from the horizon to what's right in front of us. And of course, the right in front of us is the ongoing need. In fact, the need right now for a lot of you to decide on your annual business risk management plan. And this decision is not the same as shopping, for example, for a toaster. And so if you had a Consumer Reports type of toaster comparison that I have a little snippet from there, we've got you know, Model A, Model B, Model C, you know, I guess assuming all from different manufacturers, and we have the different features going down the side there, the 4-slice, the bagel, the stainless steel. The tick marks in each row all mean the same thing. So 4-slice is 4-slice, stainless steel is basically the same kind of stainless steel in the cases where you see the tick marks. And ultimately, when you're shopping for something like a toaster, you want to find the best column or the best product, the one toaster that suits your needs. And you pick that toaster and keep it for multiple years, for a number of years. So I'm saying that deciding on your annual BRM plan is not like that. So here's how it's different. If you're shopping for a BRM plan, the tick marks in each row would almost always mean something different. And I'll show you exactly what I mean on an upcoming slide where I do have a comparison of programs. Secondly, it's not a matter of finding the best business risk management product. Usually, it's not a matter of finding the one product, but finding the best combination of products. Subject to availability, but I think there is going to be increased availability as we look forward to the horizon, as I've already said. A Consumer Reports type comparison is not going to give you enough information to make a good decision. I think there's a need for more education. So again, this stems back to what I was joking about there with, you know, can you learn these programs through a drip IV? That would be ideal if you could just hook up to a drip IV for 5 minutes and it would go right into your brain and you'd know it for all time. It takes more effort than that, is the reality. And so the bottom line on business risk management planning is you need to pick multiple products, but the plan would only be good for 1 year and only for your farm. So unlike that toaster where you're picking just one and keeping it for multiple years, this one you're tending to pick multiple and it's only good for 1 year and only for your particular farm because every farm is different. So here is my Consumer Reports type comparison, if you will, of business risk management overview. And along the top here, I've got Agristability, crop insurance, a couple of private products that are available in the prairie provinces, GARS and Just Solutions, and then livestock price insurance, which currently is available in the West, but you know, we hope we'll move eastward as well. various coverage types. Agristability being the only one that is whole farm, so it covers all the different types of production on a farm, not just crops, the livestock as well. Crop insurance is the only one that is individual crop and provides for spot loss coverage if there is a problem with one particular crop. These private programs relate to the whole grain farm, so the grain farm calculations are combined or worked out together, if you will, to determine eligibility for those programs. And then livestock price insurance is for livestock price only. Now, this is an example of what I was saying before, that if you have this business risk management shopping comparison, that these tick marks, unlike the ones for the toaster example, they don't mean the same thing. So yes, it means that except for livestock price insurance, all of these products cover production, but they all do it a little bit differently. And the reason that is because each program has different parameters, different ways of calculating both the coverage and the benefit. And so they're not all going to cover production the same. Same holds true for some of these other things too: price loss, increased input costs. So where the tick marks are there, they don't necessarily cover them the same way. And then you have this situation here where agristability is the only one that covers fuel and labor and some other costs that these other ones don't cover. Now, the tendency when I show something like this to producers is for them to take this, what's a complex decision, and try to simplify it. And so one of the results of that is not viewing the risks broadly enough. And that leads to problems. And I've got 3 of them listed here. So these are 3 things that actually come up quite commonly when we show this to people, to producers. So the first one here is, I've got 70% crop insurance, so I don't need agristability. And what this is really saying is this is trying to boil the risk down to just one of these lines. So this producer is only thinking of the production or yield loss line. They're not thinking about the price loss line, increased input costs, increased fuel and labor, or any of these other technical points here. So they're trying to boil it down to production loss only. Is that the only loss that they face? Probably not. So in all cases here, I'm going to say that we need to encourage people, or when people look at this, they need to take a broader view of the risks. So we'll continue on because the theme is the same here. I'm irrigated, so I don't need agristability. Again, that statement focuses on this production line, and it focuses on one aspect of it, having enough moisture to yield a good crop. Doesn't focus on disease or anything like that, and is not focusing on any of these other risks necessarily, which the farm is still subject to. Or the third one here, I'm supply managed, so agristability won't work for me. That one is looking at the price loss line at the exclusion of the others. And so in all of these cases, we need to encourage producers, or we try to encourage producers, to think broadly, think vertically, if you will, take a vertical view of the risks and assess, which of these risks are you actually subject to, and what do you need to cover. Now, continuing on, looking at what's right in front of us in terms of this business risk management decision, I thought it'd be important to spend a little bit of time on agristability, because the agristability sign-up deadline is coming up. It's April 30th. And there's some good changes in the works, but there's also a significant amount of myth out there with respect to agristability. So I just want to spend a few minutes here doing some agristability myth busting. And so the first myth that we have here is that the agristability program is broke beyond repair because of the 2013 changes to trigger point and reference margin limiting. Now, the facts on the other side here are for most of the 25-year existence of programs like Agristability, there was a 70% trigger point. So the same as it is today. So back in 2013, when it changed from 85 to 70, that was a return to 70. It wasn't necessarily something new for the program. And the program was known to work well in the early years when there was a 70% trigger point. The second fact is, if agristability is broke or doesn't work for any specific farm, if this is the case here, that for most of the 25-year existence, there was a 70% trigger point, then if it is broke, it could only be due to reference margin limiting. And I would agree that reference margin limiting does present some challenges to some producers, and we're going to show you that coming up here. And so I just thrown some definitions here. I think most people are familiar with the reference margin, that's just basically the coverage level for the agristability program based on the previous 5 years with high and low dropped. And reference margin limiting, I'll show you how to interpret this in kind of a graphical format. But basically, the reference margin limiting is where your coverage level, that reference margin, gets arbitrarily adjusted downwards, making it harder for you to qualify for payments. Reference margin limiting doesn't happen to all farms, it just happens to some farms. And even if it happens to some farms, it doesn't happen to those farms necessarily every year. So it's something that needs to be watched, needs some monitoring. A further myth here on agristability is that the agristability program requires a 30% drop in revenue in order to trigger benefits. The fact on that is that agristability requires a 30% drop in margin, program margin, the current year margin, relative to the reference margin in order to trigger. This usually equates to a much lower drop in revenue required in order to trigger. So the key is to watch the words carefully there. So the myth was that it requires a 30% drop in revenue. That's not true, because it requires a 30% drop in margin, and a 30% drop in revenue is something quite different. I'll show you this coming up. So again, some important definitions: program margin, current year result gets compared to the current year result that gets compared to your coverage level to see if you trigger a payment. If the current year drops by more than 30% relative to that coverage level, you get 70 cents on the dollar. That's the contribution rate. That's the part that they're considering bumping up to 80 cents. And eligible expenses and revenues are the things that make up your program margin and reference margin. So they include the direct input costs and sales of agricultural commodities. Now, this is a graph that we've created. You're not going to find this anywhere else. I didn't get it from the government. We actually created it at MNP. It's a graph that shows the revenue drops required to trigger agristability. And the dotted line, if you will, the one that has these dots with various percentages, that's the line that we're going to look at first. But there's also some classifications here. I have the industry sectors separated into group 1, group 2, and group 3. So, take a minute there. If your crops, chances are that you're in group 2. And so what does this mean? Well, I have group 1 on the right, group 2 in the middle, group 3 over on the left. And this is meant to classify these in terms of whether they have a high cost structure or a low cost structure for agristability purposes. And so we're looking at those eligible expenses that are in the reference margin, and comparing those to the eligible revenue that's in the reference margin to get a ratio. And you'll get a ratio between 0 and 1. If you do this for your farm and you plot your farm on here, let's say that your farm plots out right about here. So between 0.5 and 0.6, if you draw a line straight up and where it intersects this line, it tells you that you will require a revenue drop of 13.5% in order to trigger agri-stability benefits. So that's relative to your 5-year average, assuming expenses remain equal. And so the thing that this graph really does well in illustrating is that revenue drop percentages can vary. So all of these things equate to a 30% margin drop for each of these groups. But you can see that the revenue drop percentages range from 1.5% to, over 30, or, in some extreme cases, over 40% way over here. Now, if you're in group 2, I mentioned before that your margin might be limited. And if it is limited, it's not necessarily limited every single year, because each year your reference margin does a reset. 1 year falls out of that 5-year that's used for the average, another year comes in, and you reassess the high and the low. So every year there is a reset to that calculation. That reset could take you out of limiting if you were limited already. It could put you into limiting in some cases if you aren't. So farms in group 2, I think, need to be on a watch list. Now, here on this part of the graph, down here, there is no reference margin limiting. At 0.5 and below, this is where reference margin limiting kicks in. You can see the line goes up sharply here. And then at 0.4, approximately, it starts to level off. That's where the reference margin limiting is capped, if you will, at 70% of the conventional margin. That's a change that they put forward in the Canadian Ag Partnership. So you can see for people in group 2, some of them might be on this part of the line, some of them might be on this steep part, requiring somewhere between a 15 and 30.6% revenue drop to trigger benefits. And some of them might be maxed out, requiring over a 30% revenue drop. The key is, where is your farm on here? That's the important thing. And how does that change every year? Because just because you're limited 1 year doesn't mean you're limited the next. And now finally, just looking at some myth busting in terms of this business risk management planning. So a couple of myths here. One is that a business risk management plan is all about finding the best program. And secondly, if we could do some extensive research and modeling for the average farm, that same plan would work for other average farms. The facts here are that you likely need to pick multiple products. So it's not about finding the best program, the silver bullet, if you will. And the plan would only be good for 1 year and only for your farm, which is why research and modeling for an average farm don't really say a lot in terms of how does that work for your farm. So I call the second one here the myth of the pixie dust, that there's some kind of magical strategy that would work for any farm. No, it needs to be assessed on a farm-by-farm basis and on a year-by-year basis. And so I guess the whole point of that segment there on what's right in front of us is the fact that it's very important to learn something about each of these programs and learn something about new programs as new programs are introduced into the mix, so that you have a better idea of how these things might go together into a risk management strategy. So now what I'm going to do is I'm going to tie together, if we think about our first segment there where we talked about what's on the horizon, the changes that might be coming, where BRM is going to end up for the 5 years starting in 2023. and even what is right in front of us right now, what's the common denominator? And to get a clue for what that common denominator is, I'm going to get it from the Agristability program purpose statement. So I just have a paraphrased version of it here. Agristability covers production losses, market price declines, and eligible cost increases in such a way that the viability of the farm is maintained through restoring a portion of the lost income and or margin. Okay, so this is a statement for agristability. I believe that there's a part of this statement that, you know, really, it was wise to put this in here. The viability of the farm is maintained through restoring a portion of the lost income and or margin. Now, maintaining viability and restoring a portion of lost income, I think is something that can be accomplished by any of these programs that I described previously there. Agristability, crop insurance, GARS Just Solutions, livestock price insurance, or anything else that gets added to the mix for that matter. So maintaining viability and restoring a portion of lost income can be accomplished by any of them. Both of those things are issues of financial literacy. So whether we're talking about viability or restoring a portion of lost income, they're issues of financial literacy. And viability can only be assessed in relation to the strength of the balance sheet and the size and consistency of the income stream feeding it. Now, if we think of someone who is really struggling in their business and you know, is told by their bank, you should go see a trustee in bankruptcy and talk to them about your situation. The first thing that happens when you go in and talk to a trustee is they say, well, let's put together a set of financial statements, because trustees are interested in assessing the viability of that business to see whether they agree or disagree with you on, you know, is your situation that bad, and to determine what to do. So viability can only be assessed in relation to financial statements. So you need to understand and be able to use your accrued financial statements, and you need to have a good understanding of these various BRM programs that I gave an overview of already in order to tie your annual business risk management planning decisions all together. But the common denominator here is the financial statements. So when you think about all these programs, they are all different. The GARS margin is different than the agristability margin. Crop insurance doesn't work on a margin, it works on production. So they're all different. How do we tie it all together? Your financial statements are the common denominator. In particular, a projected financial statement for the upcoming year. If you project that financial statement, you then have a means of assessing the risks and assessing what these programs might be able to do to fill in some of that risk, to mitigate it. So I got a couple of important definitions here. Balance sheet. This came from one of my mentors early on in my accounting career. Every time he'd go out to present a set of financial statements to any client, no matter how sophisticated, he would give this this little spiel and say the balance sheet is a picture. It's like a Polaroid. You take a snapshot as a point in time of the assets under management, liabilities owing, the net equity or actual ownership of the assets at a point in time. So it's a picture. The income statement is a movie. So the income statement takes place over a period of time, usually a year, fiscal year. Shows the movie of the revenues or sales less expenses or costs over that period, and the net income or loss for the period feeds back into the balance sheet. I've found that over the years that's really resonated with people to help them understand the purpose of those two things. So understanding accrual accounting is one of the keys to understanding and properly utilizing the BRM programs as risk management tools. And so a couple of questions for you there. Do you have accrued financial statements? Do you understand your accrued financial statements? Currently, some of the coverage levels, like the program margin for the reference margin and program margin for Agristability, those are on a modified accrual basis. So they relate in some way to the financial statements. It's important to learn and understand how they relate. GARS calculates their margin on an accrual basis. So again, how does that relate to your financial statements? Just Solutions and Crop Insurance both calculate production consistent with accrual principles. So there again, you can relate those to the financial statements as well. They are the financial statements are the common denominator. And here I define accrual accounting, keeping track of your business in such a way that you know the value of your production, are able to match the proper costs with the production, determine the income or loss for the fiscal year, and know exactly what your net equity is at the end of the fiscal year. So BRM strategies are complex when they're properly planned and when they're related back to these accrued financial statements, but I think it's worth the effort. A fulsome strategy needs to consider financial viability, so the strength of the balance sheet and the size and consistency of the expected income stream that's feeding it. But whatever your methodology, it has to answer two questions. Number one, are you in a position where you can take a hit to your equity? So can you use your balance sheet as part of your insurance strategy? And number two, how likely and sizable are various loss scenarios that you might experience in the upcoming year? And how much of those losses are you equipped to absorb versus purchasing those risk management products to cover? So if a person were to model BRM strategies, a typical process would be a projected income statement with revenue and direct input costs broken down by acre and type of crop. If you want to model crop insurance, you'd need Agristability, reference margin, quotes for various types of insurance, and you'd have to make some assumptions on various types of loss scenarios and calculate how the different BRM tools would pay out to offset those losses. Now, this Ag Risk Management Projector is a tool that MNP has developed to do exactly that. So I'm just going to give you a brief live example here shortly, but this is just some sample output, and it's important to understand the output so you'll be able to understand my live example. So this output here, you'll see that the actual output has two of these graphs side by side, but each graph is an accrued income statement projection done to CPA standards. So we're actually looking to project what the income situation is going to look like for the upcoming year for the farmer. And that's what this highest green bar is here, is the production, assuming that all the targets are met. This is the targeted production. The other green bars are just 10% reductions off of that original production down to zero crop. We can also do this for a mixed operation. So green is production. Production varies from 100% down to zero. In behind production are the costs or expenses. And in yellow or orange here, we have the Agristability allowable expenses. And in brown, we have the non-allowable expenses, all the property taxes, rent, interest, non-arm's length salaries, repairs, depreciation. That's what you'd see in the brown, and in the orange you would see the direct input costs and direct costs of production for Agristability. So when you stack up the orange and brown, that's all the costs that would be on an income statement, and the revenue, the green minus those other two things, would be the income or loss. And you can see in the case of the 100% bar and 90% bar, there is income because the green is sticking up above the costs. And you can see from 80% on down, this particular farm is incurring losses. Now, every farm's graph will look similar to this, but they are all different because every farm has different expectations of profitability. This one has 2 bars sticking up over the cost. Some of them have 3 or 4 if they're very profitable. Some of them have none. So if they have none, it's an indicator that maybe some other things need to happen before that risk management strategy is brought into play. But in this case here, the red losses are things that can happen as production goes down there, either the price or the production. So we can toggle between different production and price losses. We've got price, yield, and input sensitivities available. And we have various risk management options programmed into this thing that we introduce and that make some of these red losses disappear, if you will. So I'll now just take a minute and walk you through a brief demo here. So in front of you now is 2 graphs similar to the one that I just described. And so we've entered this farm's projected income statement, and we also have entered their quotes from various programs. And so we can show you now on the left-hand side, I'm going to introduce Agristability into this mix. So that's Agristability by itself. In this case, this operation has a limited reference margin. So I can actually show you what would happen if it wasn't limited. If you see what happened there, the bars went up slightly. So in this case, the margin is not very limited. It's probably on that steep portion of the curve or of the line that I described to you previously there. Now, it's also useful to, of course, add in multiple products and see how that works. And the idea behind it is the producer needs to engage in this and say, well, what losses is the producer concerned about? Are they concerned about these shallow losses here? Or are they concerned mainly about these really deep disasters? You know, in this case with Agristability and crop insurance at 80%, there's still a significant amount of loss. I think it reads out as almost $500,000 here, $400,000 or $500,000 that is floating on top there. So, you know, probably need to look a little further for a business risk management solution. And so here we'll add one of the private products on there. And, you know, this is where you really start to see that adding that private product on there filled in virtually all the losses, you know, going across here from the 60% bar, left some shallow losses here that, you know, sometimes it's not possible to fill in this area. We call this the saddle with the shallow losses because the coverage might not be available. Or if it is available, it will usually be very expensive because these are the most likely losses that will occur. But this, what you see here, is a pretty good strategy. Another thing that I want to reinforce here is there's a 2020 and future rule change for Agristability. And that's the fact that private insurance no longer reduces your Agristability benefits. So here you see just Agristability and private insurance, and the private insurance is floating on top of or stacking on top of the Agristability. And you can see that even with this limited margin, they're still getting some Agristability kicking in here. And of course, the scale is in the millions of dollars. So even though that's a thin sliver, still amounts to quite a bit of money relative to the $1.19 an acre that Agristability is actually costing. So I accumulate the costs down here. Total cost of Agristability only is $6,777. Total cost of this private and Agristability is $54,608. So just an example of some of the things that we can do. So what generalizations can we draw from the modeling? Again, I've mentioned this a couple of times already. You likely need to pick multiple products, but the plan would only be good for 1 year and only for your farm. The generalizations we can draw from the model that I just showed you, agristability does work even when reference margin limiting applies, and it's very cost effective. The 2020 agristability rule change on treatment of private insurance proceeds makes it much more effective, because the private insurance kind of floats on top, as opposed to sorry, I should have introduced crop insurance in there too, and you can see how with the crop insurance, it actually reduced the agristability benefit and there wasn't that much left. However, in a price drop, if I model the price drop, crop insurance doesn't cover price drops, so we always have to look at price and production. It's just that we have limited time here to show you everything. Shallow losses are tough to fill in. Everyone's coverage under various programs is different. You know, that's why I'm saying it's good for 1 year and only for your farm. Coverage is very different. Farms are different too. And there's no such thing as the best program or best combination of programs. The strategies could potentially change each year, and we recommend getting quotes for everything again and reevaluating on an annual basis. Here I just have a quote from Dave Ramsey: when selecting a financial consultant or financial advisor, be sure to choose one who has the heart of a teacher. I throw that in there just because I think it's pretty important for you as producers to learn something, not only about accounting and improve your knowledge each year, but about these programs. And so I've got you know, a series of questions here about whether is your accountant helping you to increase your knowledge and improve your records, understand accrued financial statements and use them as a tool to manage and improve your business. Did they help you understand the various business risk management programs and utilize them as business risk management tools? And do they ask you questions about your business, your financial statements, your business risk management programs, which in turn gets you asking questions and engaging in those processes and learning something new each and every time. And so that's the extent of my presentation. I've got my contact information there, as well as our Senior Vice President of Agriculture, Stuart Pearson. So I'll turn it back to Quinton to moderate the question period. And Quinton, I think this was the point where I stopped sharing my screen.
Yeah, you can leave it up for now if anybody
Okay.
wants to put down your contact information, no problem. But yeah, thanks a lot, Steve. That was awesome. I think everybody would have pulled a little bit of information from that for sure. Lastly, I'd like to thank MMP one more time, and then we've got a few questions here if everybody has a minute. First, did you say that even farms with limited agristability margin might be able to trigger agristability benefits at less than a 30% revenue drop?
Yeah, that's correct. And so I'm going to move off of the contact information here to just go back to one of the previous slides. So this is the slide where that's illustrated. So I mentioned that at this point here, the limiting starts. At this point here, the limiting caps. And so you can see that there's a number of farms that are limited here in this range that would require less than a 30% revenue drop to trigger benefits. It would be between 15% and 30% in this range. And as I said, the farms can move in and out of that range depending on their reference margin and the year that's falling off, the year that's coming in, and how it resets. The other thing that I'll draw attention to is this green line here, the 70% trigger with no reference margin limiting. So of course, this is one of the options that might be accepted today, right? If they take away the reference margin limiting, and you can see that the revenue trigger point line would extend across like this. So that would be a tremendous benefit for these producers who have limited margins. Their revenue drop would be a lot less.
Right, no, perfect. I think that kind of ties back to what you said about picking your advisor as well at the end there. It's important to have that person on your team to help explain this type of stuff. One more question and then we'll wrap it up here, just we're getting a little long on time. When you were talking about the Agristability changes that are being decided on today, one of the items you had on the slide was changing contribution rate from 70 to 80%. Does that mean the program would trigger 80%?
No, that contribution rate is different than trigger point. Contribution rate is once the program triggers, how many cents on the dollar is it going to pay? So that is the thing that might be going from 70 to 80 cents. Sorry. So the trigger point would still be a 30% margin trigger, and it would be below that point where it would be 80 cents on the dollar now instead of 70.
Okay, actually we had one last one come in here from the audience, so I'll get that one in too. I had a 2019 Agristability payment and found that it paid 70% of 70% reference margin decline. I'll be asking MMP for clarification on this. Thoughts? So it paid 70% of 70% reference margin decline.
Yeah. I think for that one there, I would need to chat with the individual to see if they're talking about a situation where there's a limited margin.
Right. Well, yeah, and like you said at the end there, your contact information and phone numbers there. So I feel free to reach out to Steve to get some more clarification on that one.
Normally, you have a 30% drop before the benefits start accruing, and then so after that 30% drop, you are left with 70% of your margin, and you will get 70 cents on the dollar. So that is 70 of 70. But just the way that question is worded makes me wonder whether there's something a little more behind that there might be a limited reference margin scenario, and that's a little bit more complicated discussion.
Right. Okay, well, I think that's good then. That'll be our last question for the day. So before we end here, I'm just going to pull up this portion. Steve, you might need to turn off your webcam there so everyone can see the barcode. There we go. So here's your chance to collect one CCA CEU in professional development. To collect the credit for this webinar, please open your CCA app on your smartphone, click scan course code, and hold your phone up to the monitor so the camera can hover over the QR code. If this does not work for you, please email your first name and last name and CCA number to topcrop@annexbusinessmedia.com and we'll submit your credit for you. These instructions will also be found in our follow-up email, which will hold the recording of the webinar. Well, with that, thanks again, Steve, for the presentation, and all of you for tuning in today. Don't forget to visit topcropmanager.com/webinars to view all of our previous webinars, and we hope you'll join us for our next installment of this series happening on April 15th. So I think that's good. Thanks again, Steve.